$200 a month, that's less than a lot of us spend on eating out. Put that into the market every month for 30 years at a return roughly in line with history, about 7% a year, and it grows to around $244,000. Only $72,000 of that is money we actually put in. The rest is just time doing the work. And the strange part isn't the math, it's that most people who understand this exact math still wait a decade to start. 6 episodes got us here. We understand why investing matters, how the market works underneath the noise, what the building blocks are, and how to actually begin. But knowing all of that and having nothing to do on Monday morning is like owning every ingredient and no recipe. So this episode is the recipe, the roadmap. 5 ordered steps, calm and concrete, that take us from the first dollar we set aside all the way to financial freedom. Steps that we can start on this week. And here is something to hold on to until the end. The investors who actually get all the way there, who reach the point where they no longer need a paycheck, they are not the ones with the highest income or the best timing. There is one thing they all share, and we will name it before this is over. Hey, I'm João, and welcome back to Investing Basics for Beginners. This is the 7th and final episode of the series. Quick tour of the road so far. We covered why inflation quietly forces us to invest, how the stock market actually works, the building blocks, stocks, bonds and ETFs, the difference between active and passive approaches, how to start with as little as $100, and the mistakes that trip up most beginners. 6 episodes of understanding. Today we tie it all into one path. Here is the shape of the whole thing. 1. Build the foundation. 2. Invest consistently. 3. Grow what we put in. 4. Avoid the traps. And 5. Stay the course. That's it. Nothing exotic. Let's walk them. Step 1. Build our foundation before any serious investing. And it has 3 parts in order. First, clear high interest debt. This is the one that comes before everything, and it is why. A credit card in America right now charges on average about 21% a year. That's the figure from the Federal Reserve. Over the last 100 years, the US stock market has averaged about 10% a year. So carrying a 21% balance while investing for 10 is like bailing water into a boat faster than we can scoop it out. Paying that card off isn't giving up on investing. Paying it off is the investment. It's a risk-free return of about 21%, more than double the market's long-run average, and there is nothing we can buy that beats it. So anything above roughly 8 to 10%, credit cards, payday loans, aggressive consumer credits goes first. Second, an emergency fund. 3 to 6 months of essential expenses, sitting in cash or a high-yield savings account, not invested. Borrowing on purpose. This is the cushion that means one surprise doesn't blow up the whole plan. The Federal Reserve found that only about 55% of US adults could cover even 3 months of expenses. The other 45% are one job loss or one medical bill away from being forced to sell their investments at the worst possible moment. I know that one from the inside. Early on, before I'd built my cushion, an unexpected expense forced me to sell right when I shouldn't have. The foundation isn't the exciting part, but it protects everything built on top of it. Third, before optimizing anything, build the habit. Putting money aside every month, even a small amount until it's automatic. Get the habit first, optimize later, because clearing that debt is the first investment we make and statistically the best returning one available to us. Step 2. Start investing consistently. Not heavily, not perfectly, consistently. $50 a month or $500, what matters is that contributions keep coming every month, no matter what the market did that week or how we feel about it. The how is deliberately dull. Pick a broadly diversified index fund, an S&P 500 or a total market ETF, maybe that plus a bond ETF, automate a monthly transfer and step back. That's where compounding gets to work. $200 a month at about 7%. Again, That's roughly the historical average, not a promise, grows to around $244,000 over 30 years. 500 amount gets to about 610,000. None of that needed us to pick a single winning stock or time a single trade. Want to run your own numbers? Head to joaofreire.finance and open the compound interest calculator. Two more things make the case for keeping it simple. Over 15 years, about 89% of actively managed large-cap funds underperformed the index. That's from the S&P Dow Jones indices, which tracks this every year. So a plain index fund isn't the lazy choice, it's the one the evidence points to, and there is a quieter lesson in the data. The research firm Morningstar looked at the 10 years to the end of 2023 and found that investors in a given set of funds end up, on average, about a percentage point a year behind those same funds on returns. Same funds, a gap between what the fund did and what its investors got. Whatever the full explanation, the simplest way to stay close to the fund's return is to leave it alone. $250,000 from $200 a month took no genius, just the discipline to let it run. So, 2 steps down. The foundation's built, the money is going in every month, the system is running, the mechanics aren't complicated, but the question from the start is still open. What do the people who actually reach financial freedom do that the ones who understood all of this and still never got there didn't? 3 steps left and the answer is in them. Step 3. Grow our income and our contributions over time. Compounding works on whatever we feed it, so the biggest lever after starting is simply feeding it more as life allows. A simple rule: every time income goes up, at least half of the increase goes straight to investing. A $300 a month raise means $150 to the brokerage automatically and $150 to daily life. The system grows with us instead of freezing at year 1 amounts. Remember, the gap between $200 and $500 a month was about $366,000 over 30 years. Almost all of it is explained by how much went in. And the tax code quietly rewards patience twice. Hold an investment more than a year and it qualifies for the long-term capital gains rate, which for 2026 is 0% for most middle-income fillers, 15% for the majority of us, and 20% only at the very top. That's the IRS on schedule. On top of that, tax-advantaged accounts stretch the advantage across decades. A Roth IRA, we put in money we have already paid tax on, and every dollar of growth after that 30-40 years of compounding comes out completely tax-free once the account's been open 5 years and we are past 59.5. A traditional 401k works the other way. It lowers our taxable income today and grows tax-deferred until retirement. Either way, patience pays twice. Once through the returns and again through the taxes we never hand over. Set the half raise rule once and it keeps paying us for as long as we keep it. Step 4. Avoid the traps. This is the discipline step and it's really just 4 don'ts. Don't chase hype. Jumping into whatever is running is the surest way to buy high and sell low. Don't panic sell. Every major market decline of the last century has eventually been followed by a recovery. In the crash of early 2020, the S&P 500 fell about 34% in 33 days, then reached a new all-time high roughly 5 months after the bottom. The people who sold near the low watched that recovery from the sidelines. Watch the fees. The average actively managed equity fund charged about 64 hundredths of 1% a year, versus about 500ths of 1% for the average index fund. Roughly 12 times the cost, and that gap compounds into a real slice of the outcome over decades. And stick to the plan we already made when we were calm. It is the reframe that makes this doable. Discipline isn't being unemotional. We will feel the urge to sell when everything is red and the itch to pile it when something is flying. Discipline is trusting the plan we made in advance enough to override the surges in the moment, because we already did the hard thinking back when we were calm. None of these traps take intelligence to avoid. They take a plan made ahead of time. Step 5. Stay the course. And this is the answer to the question we planted at the start. The investors who reach financial freedom aren't the ones who timed every move or found the perfect stock or earned the biggest salary. They are the ones who keep showing up month after month, market up or down, boring month after boring month. The US stock market averaged about 10% a year over the last century, but it got there through crashes and recoveries and long flat stretches, not a smooth line. Across decades, the direction was upward because the companies inside the index keep producing more value, and financial freedom stripped off all the marketing. It's simple, the point where our investments produce enough income that a paycheck becomes optional, where work is a choice. It doesn't come from one brilliant move, it comes from a system that runs steadily for years, investing treated like brushing our teeth, boring, daily, non-negotiable. So, the one thing they all shared, the thing we have been holding since the first minute, they keep showing up. The boring version is the version that works. The full roadmap in 5 lines. 1. Foundation first, kill the high interest debt, build the cushion, form the habit. 2. Invest consistently in a diversified index fund, automate it, and step back. 3. Grow contributions with every raise. 4. Avoid traps, hype, panic, fees, and drifting off the plan. 5. Stay the course, because the boring version works. One thing to do this week. Look at step 1, wherever we are on this road, that's where we start. This week, not next month. And if we have made it through all 7 episodes, we already understand more about money and investing than most of the people around us. The hard part now isn't knowledge, it's practice, one steady month at a time. That's the end of Investing Basics for Beginners. If this series made the path clearer, subscribe so we can keep walking it together. There is more to come. Thank you for being here through the whole thing. Same boat, same road. I will see you in the next one.